Oil Stock Options by www.profitabletradingtips.com. Big oil companies have spent decades perfecting a technology that allows them to extract oil and natural gas locked up in shale deposits. This is called hydraulic fracturing, or fracking for short. It is a process of injecting liquid under high pressure into subterranean rocks, forcing open existing fissures. After oil companies have spent billions on developing this process, there is an oil boom in the USA. The USA is much less dependent on foreign sources of energy and may become a net exporter of oil once again. But it appears that no good deed goes unpunished. As we noted in our article last week about trading oil futures, there is an oil glut and prices have fallen dramatically. MarketWatch notes that oil has hit 5-year lows, not seen since the depth of the recession in 2009. Crude oil prices again tumbled to 5-year lows Monday, pressured by forecasts that a global glut of oil will persist in the first half of next year. On the New York Mercantile Exchange, crude futures for January delivery CLF5 minus 4.13%, dropped $2.79, or 4.2%, to settle at $63.05 a barrel. The U.S. oil benchmark logged the lowest settlement for a front-month contract since July 16, 2009, sliding further just one session after ending at levels last seen on July 29, 2009. Consumers are happy as it now costs less to drive your car, heat your house, and run your factory. But oil stocks are hurting. Our interest at this time is in how long this situation will last, when will it turn around, and how to trade oil stock options to make a profit. Oil stocks. The St. Louis Post-Dispatch reports that energy shares were a prime reason for a recent drop in stock prices. U.S. stocks fell in afternoon trading on Monday as a drop in crude oil prices to a 5-year low hammered energy stocks. Weak Chinese trade figures and news that Japan's recession is deeper than initially thought also weighed on the markets. Oil impact. Energy shares in the S&P 500 dropped 4%, by far the biggest loss among the 10 sectors in the index. That followed a drop in the price of crude oil on more evidence of weak growth in Asia. Benchmark U.S. crude sank $3.05, or 4.6%, to $62.78 a barrel in New York. Brent crude, which is used to price oil sold on international markets, dropped $3.08, or 4.5%, to $65.99 a barrel. Both prices are at their lowest levels since 2009. Two big energy companies in the Dow, Chevron and ExxonMobil, fell sharply. Chevron lost $4.35, or 3.9%, to $106.53, and ExxonMobil fell $2.40, or 2.6%, to $91.42. The point of looking at oil stock options at this point is that it may take months or even years for the price of oil to come back up. If the recessions in Japan and Europe and the economic slowdown in China weigh heavily on world economies, the supplies brought to the surface by fracking technology may be creating a long-term oversupply. Oil stock options. Even with the high volatility of options trading in energy stocks, it is possible to ferret out potentially profitable trades in the near term. An example is highlighted in Forbes' Stock Options channel. They discuss an options approach for ExxonMobil. This week we highlight one interesting put contract and one interesting call contract from the January 2016 expiration for XOM. The put contract our Yield Boost algorithm identified as particularly interesting is at the $60 strike, which has a bid at the time of this writing of 92 cents. Collecting that bid as a premium represents a 1.5% return against the $60 commitment, or a 1.4% annualized rate of return. At Stock Options channel, we call this the Yield Boost. Go to the link to read more about oil stock options on ExxonMobil. For more insights and useful information about trading stocks, commodities, or Forex, visit www.profitabletradingtips.com.